This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos about entering late in trends. You'll often hear people talking about a FOMO trade, F-O-M-O, fear of missing out. In a bull trend, there's a bull FOMO trade. Traders are afraid to buy, but they're afraid not to be long, so they buy small. And if everybody buys, the market tends to go up in a small pullback bull trend. And there's often a bear FOMO trade as well. When the market's going down, everyone's afraid to miss out, so everyone tends to trade small, not waiting for pullbacks, and the result is a small pullback bear trend. We have a bull trend and a tight trading range, a bull trend and a tight trading range. What's going to happen next? Well, we pulled back for a couple bars, a little bit of a buy climax, buy climax, buy climax. It's reasonable to take that buy with a stop either below the bottom of the most recent bull leg or down here. And then other traders will buy the close. We have a bull breakout, maybe good bull bar, buy the close, buy the close. You'll sometimes hear traders talk about noise, that the market's in a tight trading range making lots of reversals and it's not tradable and it's just noise. Well, that's really not what's going on. When an experienced trader uses the term noise, he's not meaning something that is random. He's simply meaning that the movements are too small for him to bother to do anything. If he's long, he's not going to get out if there's noise. If he's looking to buy or looking to sell, he's not going to take an entry in the presence of noise. He's waiting for something bigger. Noise is usually something that's simply too small to trade. And you can see what happened. In this case, we got trend resumption up, and in this case, we got trend reversal down. And in both situations, the market was telling us something about what is likely to follow. And therefore, it's not noise and it's not random. It is giving us information. I'll talk about that more in this video, what the difference is between this and this. And there are some important differences between the two. If you simply look at both tight trading ranges as noise and you don't give them any other thought, you're missing clues to what might be following. Noise cannot exist. It's not random. It simply means that the reversals are smaller than what you care to trade. However, there are computers out there who are very comfortable trading those small reversals, and they're doing it logically based upon math, and therefore the events are not random. We have an opening reversal and then a bull trend. We got bull trend, trading range, trend resumption up. Very easy to not trade the bull trend here or here. If you find yourself missing a lot of bull trends like that, it's probably because you're afraid that the stop is too far away. You know that no matter where you buy in here, your stop is down here. And it might be greater than what you can afford to risk. For example, if you bought high up in this bull trend, your stop is 20 points away. And if you have a small account, you cannot risk 20 points. That's $1,000 in the E-mini. And the same thing here. If you bought anywhere here, your stop is all the way down here. Again, possibly as much as 20 points away. In that kind of a situation, if it is greater risk than what you're comfortable undertaking, then simply don't take the trade and don't worry about it. You'll sometimes hear traders on television talking about a buy the close bull trend like this as a FOMO trend, a fear of missing out. And what happens is the trend enters a fairly tight bull channel with very small pullbacks. Everyone is fearful of a big reversal, but they're also more afraid of missing a big move. So they trade small, use the appropriate stop, and as the market goes higher, they buy more. And the result is the market just keeps going up and up and up. The traders who are waiting for a pullback sometimes have to wait a lot of bars before they get their pullback. One technique that I use in trading FOMO markets, small pullback markets like this, instead of waiting for the pullback, a lot of times I'll simply buy the close. Anytime I start to get 3, 4, 5 consecutive bull bars closing near their highs, I simply just buy the close, look where the stop has to be, and trade small enough so that my risk is not greater than any other trade. I also sometimes will trade half that size to allow for the market to pull back deeply, and then I can buy more and lower my average entry price. And a lot of traders just keep buying. They buy at the market, they buy below bars, they buy bear closes, they buy above bars, they buy bull closes, and they keep buying until the market transitions out of its breakout phase into a channel phase or into a trading range, and then they adjust their style of trading. These traders know what to do if the market reverses down. They know how to manage their trades. The risk of the market falling sharply after reversing up this strongly is small. And if it does sell off, almost certainly a trading range is more likely than a bear trend, and they can buy more lower, expecting the market to get back to the top of the range, where they can exit break even on their earliest entries up at the top of the range, and then with a profit on their later entries lower in the developing range. The same up here, buy the close, strong breakout, a bull bar follow through, even though it's small, chances are the market's going higher. Traders can buy one or more of these closes, confident that the probability is high that they'll make money. It does not matter where you bought. If you bought above this bar or any of these closes, it's a small pullback bull trend. The stop is below the most recent major higher low, and that is here. Traders who are waiting for a pullback, they miss a huge bull trend. And when the pullback comes, they don't see it as a pullback, a bull flag. Instead, they see it as a reversal, and then they use that as a reason not to buy. The market's in a trading range here, so bears are looking to sell high, at least for a scalp, and bulls are buying low, either for a scalp or for a swing. Even though after 20 bars, the probability of a reversal is almost as big as the probability for a bull trend resumption, it's always slightly more likely that the trend that came before will resume. Most traders would not sell here because this is very strong, and now we're starting to get 8 or 10 more bars in a small bull trend. It looks like we have a double bottom bull flag, and it looks like we are resuming up. The bears who did sell this high, betting on a double top, now are trapped. This breakout bar and that follow-through bar is more likely going to lead to a measured move up, maybe based upon the height of the range. And the bears see that, and they are giving up. The weak bulls are trapped out. They don't want to buy high. They see this as a trading range, not as trend resumption. So the weak bulls are trapped out, hoping to buy a pullback. When they finally get their pullback, they're afraid to buy, or if they do buy, they get out with a loss as the market tries to reverse down. In any case, the bears who sold this high are trapped into a bad trade, and the weak bulls are trapped out, constantly hoping for a perfect setup that cannot exist. Experts know that the bears are trapped in, and that there are a lot of weak bulls trapped out, and therefore they buy. They buy with confidence, knowing that the first reversal down probably will be a bull flag and will probably continue higher. Buy the close trades look easy when you print the chart out at the end of the day, but trading them real time can be difficult. But you can take them as long as you're comfortable managing an attempt at a reversal, knowing that whatever reversal you get will probably be minor and the bull trend will resume, and the best the bears probably will get is a trading range. And if they get a trading range, even if you bought the worst price, the top of the bull breakout, you should be able to avoid a loss or possibly even make a profit. Here we have 3 consecutive bear bars. We have a 2-bar reversal. If you want, you can call it a parabolic wedge, first push here, maybe second push here, and then third push here to a buy climax, a failed breakout above the high of the day, and you have 3 consecutive bear bars. However, what's more likely, the start of a bear trend or a trading range and then trend resumption up? When the bull channel is this strong, especially when it's reversing off a strong sell-off, the odds are the best the bears get is a trading range. Here they got a trading range that lasted 30 or more bars, but the market still resumed up. The math is really good for the bulls. Obviously, it's less good the more bars that get added to the trading range, but especially early on, buying these closes, buying the reversal down, buying for any reason, the math is good. The trader's equation is very good. The probability of making money is high. The probability of the reward being greater than the actual risk is high. And because of that, many of the bulls scale in. They buy more if the market goes against them. Here we are rallying for 10 bars, 20 bars. What's going on? Are the bulls acting like the bears are trapped? Are the bulls buying closes, creating a big breakout, creating a lot of problem for the bears? If so, the bulls are buying aggressively, and you have to assume the first reversal down will be limited to either a trading range or a bull flag. Think about it from a bear perspective. If you're short for any reason, double top, or possibly the top of a trading range betting on a double top reversal, and then you start to see this. If you're a bear and you did not exit, what are you thinking? You're thinking, oh my God, I cannot take the pain, I gotta get out. So the bears are buying, and the bulls are buying as well. Up here, what's going on? Are the bulls acting as if the bears are trapped, or are the bars small and sideways with lots of small reversals? Is the market more balanced? Are the bulls losing confidence? Are they beginning to take profits? That's what's happening here. Instead of a buy the close rally with very little pullback and no bear bars, very few and small tails on the tops of bars, here we're getting bear bars, bear bars, bear bars, and the bull bodies are very small. What are the bulls doing? They might still be buying the low of that bull bar. They might be buying that bear close. They might be buying above this bar and buying more lower. However, they're no longer creating a strong buy the close bull trend. They're no longer holding onto their longs. They're scalping. They're buying low and taking quick profits. And therefore, the bulls see the trend as transitioning into a trading range. Well, what do the bears do when they start to see the market go sideways like this? They start to sell above bars and they start to sell bull closes near the top, confident that the bull trend is not going to resume, at least for a few more bars, and that we're probably going to go sideways or down, and therefore they can make money with limit orders scalping. A fairly prominent tail. It's still by the close, but now we have a fairly big bear bar, a micro double top, and this is pretty climactic. 4 consecutive bull bars with very little overlap occurring late in a bull trend. I don't have the measured move drawn, but this breakout is probably a measuring gap, and we're probably around a measured move up. It's a third push down, 1, 2, 3, and therefore it's also a possible wedge. If you're buying up here, you have to change your goal. A continued rally like this is not likely. After 10, 15 bars, it's probably not going to go up for 20 or 30 bars. Probably soon we'll start to transition from a strong bull trend into a trading range or a weak bull trend. That tail on top of the bar, especially after this climactic move and this reversal down, are signs that the bulls are beginning to take profits. Their stop is too far away. They have to reduce their risk. The easiest way to do it is by reducing their position. They're selling. Can you buy that close? Can you buy below the low of this bull bar? I think you can only do it if you're willing to use a wide stop and scale in lower. Maybe you put a stop below this bar, the final buy climax, testing the breakout point here. We have this gap. Technically, the best stop is all the way down here. A lot of times when you get a buy climax, especially late in a bull trend, there's a magnet just below its low, and the market often comes down to just below that low and then bounces. And then the buy climax becomes a bull leg in an eventual trading range, like this buy climax, and then a sell-off to below its low, testing near this low, and the market goes sideways for a lot of bars. Let's say you bought this close, and you were disappointed by the big tail on the top of the bar, and by the two bars that followed. You're thinking that, well, yes, it was buy the close, but the downside risk is small. However, maybe it'll go sideways a few bars and resume up. A lot of the bulls who bought the close of that bar, they did not like the tail, and they did not like this follow through. So what do if you're a buy the close bull who bought that close and now you're disappointed? Well, a lot of those bulls will place a limit order to get out break even, and a lot of bulls will not buy higher, and the result is you get this. The bulls, instead of buying higher, are now instead looking to get out around break even, around that close. And the absence of buying resulted in this vacuum down to that close. The bulls at this point, after these two doji bars, are thinking that maybe they bought the final high close of the day. What's more likely, a continued strong bull trend or sideways to down? Probably sideways to down. Buy the close bulls, disappointed by the tail and disappointed by the follow through. And then you get this reversal down. A lot of the bulls will get out break even if they bought that close, and they'll wait 5 or 10 or more bars to see what we get. Maybe we'll get a deep pullback and they can buy lower, or maybe we'll simply go sideways and get a good looking buy setup, and then they'll buy again here after they've given the bears 10 or more bars to take control. If they see the bears unable to take control, the bulls will buy again. Had you bought here and the market just sold off abruptly like this, you can buy more lower, like 2 legs down, 1 pullback 2, buy above a bull bar here or here, and rely on your stop, either below this last leg up or all the way down here. As I said, a lot of the bulls who bought this close did not like that tail, and then they certainly did not like 2 bars right afterwards coming back to that close. The buy the close bulls are trying to sell. They want the market to come back below that close and sell. And a lot of the bulls would exit break even after they see 1 or 2 of these bars, so they'll start to sell around break even. After this big bear bar, the bulls who did not get out are even more disappointed, and they're looking to sell any little bounce to get out with break even or a small profit. I also want to talk a little bit about a FOMO bear trade. Bear traders afraid to miss out, and therefore they just sell, and it results in a very strong bear trend. We went sideways, we got a bear breakout, and then a small pullback bear trend. Strong breakout. We closed below the low of the past 30 or 40 bars, near the low of the bar. The bar is much bigger than the prior bars. And then the next bar has a bear body as well. The odds are we're going at least a little bit lower. Traders can sell for any reason, like on the close of this bar or better, the close of that bar, and the stop goes above the top of this bear reversal. Some traders look at this and say, oh my gosh, I have to risk 6 or 7 points to take that trade if I sell that close, and that's far more than I am comfortable risking. I want to sell a pullback. And they wait and wait and wait. When they finally get a pullback, they think, oh, it's a wedge bottom. Trying to reverse up again and a third time, and they don't sell. And then they're trapped out again by this, and they're hoping to sell another pullback, and this pullback's not big enough. And they end up missing the entire trade. All weak traders are afraid of risk, and the weak bulls are afraid of risk as well, especially in a bear trend. And because of that, they want small risk, and they end up buying reversals in a very strong bear trend, thinking that if I buy above this bull bar, my stop is below the low, I'm not risking much. But if you do that 1, 2, 3, 4, 5 times, at the end of the day, you did not lose much money on any one of those 5 entries. However, when you put the 5 of them together, you ended up losing a lot of money in your effort to reduce risk. It would have been much more profitable to sell and use the appropriate stop, even though it's far away, but much higher probability of making money. The weak bulls buy every small reversal, especially above a bull bar closing near its high. They're constantly seeing wedge bottoms, 1 reversal, 2 reversal, 3 reversals, and then a failed breakout below a wedge, and now a second leg down, trying to reverse again, and now another wedge, 1, 2, 3, and then a failed breakout below that wedge. They're constantly seeing reasons why the market will reverse up, even though they know that the probability is high that every one of these reversals is much more likely to become a bear flag, leading to a resumption of the bear trend, than it is to become a bull trend. These are minor reversals, not a major reversal into a bull trend. And as I said, the loss on every one of these is small, but if you take enough of them, you're going to end up losing a lot. And it's comparable to bleeding to death from 1,000 paper cuts. You still end up dead. I think one of the best techniques to avoid missing a strong bear trend is to sell closes. Once you look at the market and you see it selling off strongly and you're saying, oh my gosh, I want to sell a pullback, sell at the market and use the appropriate stop. If you're desperate to get in, the market's probably going lower because everyone wants to sell. And everyone's afraid of missing out, and therefore everyone's trading. The stop is small, and therefore they trade small. However, if enough traders do it, the result is a relentless small pullback bear trend. You sell the breakout, another breakout, sell that close, trying to reverse up. Don't buy the reversal, sell the reversal. Sell at the high of this bull bar, sell that bull close. We have another breakout attempt here. You sell below the low of the prior bar. You sell above the high of the prior bar. Because of the potential wedge, I personally would not sell the high of that bull bar. However, we have a double top bear flag here. I do not have the moving average drawn in, but it's probably just below the moving average. We have a decent bear bar, so I'd sell below the low of that bar, and then sell closes all the way down. Every one of these bear closes, you wait until it closes, you get your finger on the button. As soon as it closes near its low, you just hit sell the market. And a lot of traders are doing that. Look at the open of this bar. It's at the high of this bar. And look at the close of the bar below. As soon as that bar closed, a lot of traders hit sell the close. And the result was the high of this bar, the open of this bar, is below that close. And the same here. It tells you that the bears are extremely bearish and extremely eager to sell. As soon as any one of these bars closes, a lot of traders are just selling at the market. You have other traders just selling at the market as the market's falling. They don't wait for the close, they just sell. Very strongly bearish, sell the close bear trend. If you take any of these sells, your stop is up here. After 3 or 4 bars down, you have a strong enough breakout. A lot of the bears will move their stop here. So these bears, their stop is here. And once you see 3 or 4 bars here, you can tighten your stop to above the high of this most recent bear breakout. And that's true for the bears who sold here or up here as well. Once you've had a new breakout, it's probably going to be a major lower high. You can move the stop down, trail it to just above the major lower high. I began by talking about very strong bull trends, trends that when you look at them, you say, oh my gosh, I really want to buy a pullback. That is a fear of missing out trade, a FOMO trade, and experienced traders, when they start wanting to buy pullbacks, they buy at least a small position at the market because they're afraid the market may go a long way up before there's a pullback. They're afraid of missing out. so they buy small. The opposite is true in a very strong bear trend. If you're looking at the trend and you're saying, oh my gosh, I really want a pullback so I can sell with smaller risk, that means it's a fear of missing out trend, a sell the close bear trend. And it's much better to simply do what everyone else is doing and just sell at the market, trade small enough, and use the appropriate stop, hoping that the market quickly goes your way so you can take a quick profit. Knowing that if you get a reversal, the odds are very high, it'll be minor. You can sell more higher and then avoid a loss when it gets back to your original entry point. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 5 videos on entering late in trends. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on entering late in a trend. Every bull trend has a final bull trend bar and then a reversal. And that means every bull trend has one close that's the highest close of the bull trend. And every bear trend, after it reverses, you can look back and you can find the low close of the bear trend. And those prices are important. When a trend is particularly strong, for example, a bear trend, traders will sell every bear close. As soon as the bar closes, they'll hit sell the market. The opposite is true with a bull trend. I'll talk a little bit about buy the close bull trends as well. You can see there's a candlestick chart that I have grayed out, and on top of it I have a line chart. And a line chart simply pays attention only to the closes. It connects each close with a line. It ignores the low price of the day. It's only interested in the closes. Here, the high of the day is slightly above the high close, and it's ignoring the high price of the day. It's only interested in the high close of the day. A lot of institutional traders only pay attention to line charts, and they ignore the highs and lows of the bars. They're only interested in the closes. For example, the high close of the day is the close of this bull bar, and there's a little tail on top, and the actual high of the day is slightly above. This is more obvious down here. The lowest close is this bear bar's close, and the actual low of the day is lower. A trader looking at only a line chart does not see that. He only sees the lowest close of the day. And again, institutional traders, a lot of them only look at line charts, and they don't care about the low of the day. They only care about the lowest close, and therefore the lowest close is important support. They also don't care about the highest price of the day. All they care about is the highest close, and therefore the highest close is resistance. If you were to put a dot on the close of every bar and then connect the dots with a line, you would have a line chart. And line chart traders ignore all the other prices. They're only interested in one price every 5 minutes, the final price of every 5-minute bar. This is the same chart. We have a bear trend, and then we're getting a pullback. After the reversal, you know this is the final bear trend bar. And we have a bull trend, and now we're getting a reversal. At this point, this bull bar is the final bull trend bar. If the market goes higher, then we'll have a different final bull trend bar. But at this point, this is the final bull trend bar of the day. When you see a bear trend and then you get a reversal, a lot of beginners get confused and afraid. Experienced traders view confusion as an opportunity. It tells them that the market is no longer doing what it was doing. It was in a bear trend, and now we're getting multiple reversals, and it's no longer in a bear trend. It's in a trading range, and they trade differently. They don't get upset by it. They just understand what's going on, and they just modify how they're trading. Whenever there's fear or confusion, there is opportunity if you understand what's going on. Once you see a bull trend reverse down like this, it's easy to find the final bull trend bar, and it's also easy to find the highest close of the day, which is the close of this bull trend bar. Here we have a bear trend, and after it reverses, it's easy to look back and find the final bear bar, which is this bear bar, and it's also easy to find the lowest close of the day. Every now and then you'll hear me talk about noise. Noise does not exist, and it's a term used by, I think, ignorant people who fail to understand that the market is providing information, but the information is too small for them to pay attention to it. Noise implies things are random. Nothing is random, but oftentimes lots of things happen on a chart that are too small for you to modify what you're doing. If you want to call that noise, you can call it noise, that's fine. However, there are computers that are trading all of those small reversals, and it's not noise to them. It's not random. It all has meaning. Let's say you look at this and say, oh, that's just noise. Look at all these reversals in here. It's not noise. And you're making a mistake ignoring what the market is telling you, and it's giving you a lot of information through here. I want to talk a little bit more about a sell the close bear trend and what just took place in the chart that I just showed. When a bear trend is strong, traders are selling for any reason, and a lot of traders like to sell the close. As soon as the bar closes, they hit sell the market, and they get filled at the open of the next bar. I have it shown as the close of this bar. Some traders sell right before the bar closes, and they get filled right around the close of the bar. And they'll keep doing it until it's no longer profitable. When they enter, they pay attention to the follow-through. Here we have a big tail. Most traders would not sell that close, but experienced traders would because they're comfortable managing their trade. They know that if it goes up, the reversal will be minor and they can sell more, and the market will pull back and allow them to get out at their average entry price. They sell that close, they sell more higher, it comes back below their average price, and they can get out break even and they avoid a loss. On the other hand, if it kept going down, they'd make a profit. If you did sell that close and you saw this bull bar, what are you thinking? Well, a lot of the sell the close bears who sold that bar are disappointed. They wanted the market to keep going down so they could make a quick profit. But this is a disappointment bar. That means the market might be transitioning. We might be getting a minor reversal, and the sell the close traders then will pay attention to what goes on over the next several bars. This pink line is the low close. And what's going on here? The market comes down to the low close, goes up, down to the low close, goes up, down to the low close, goes up, gets near the low close and goes up again. What does that tell you? It tells you that the bears who sold that low close are sufficiently disappointed that they're buying back their shorts at or around that low close. They're no longer confident that the market's continuing down, and they're afraid it's either going to go sideways or up. The market's only falling a tick or so below that low close and then reversing up, reversing up, reversing up. That means the bears are losing confidence in the bear trend and they're buying back their shorts. If the bears are buying, that's a problem for the bear trend. You know the bulls are buying. They see the same thing and they're placing limit orders to buy that bear close, thinking that maybe it's the final bear trend bar of the day, and maybe it's the low close, and therefore it's support, and the bulls place limit orders to buy at that close, or a tick or two above, believing that the bears will give up, try to get out break even, and the market will therefore reverse up. Remember, the market has to get one tick below that low close for the bears to get out. If it just gets to that low close, most of the bears will not be able to get out break even. And what took place here? The bears are even more disappointed, and the ones who did not get out, thinking that the first reversal up was minor, now are eager to get out. What happens? They placed a limit order to get out at that low close, and this low did not reach that low close. And therefore, the bears who tried to get out over here, break even at that low close, are trapped. And you can see they're giving up here. And the bulls see that, and they're buying as well. They see the bears giving up, and they expect the market to go higher. Usually when the market makes repeated attempts to do something, here the bears are repeatedly trying to get down to that low close, and they're unable to do it. Here, even more so, they could not even get to the low close. It then usually tries to do the opposite. Here we're in a bear trend, and are the bears disappointed? No, they're selling closes, and they're selling constantly as the bars are forming. The market is probably going lower. The bulls are trapped. The bears are confident that the bulls who were long up here are desperate to get out. As a result, the bears are selling aggressively. For example, every time a bar is about to close, they sell. As soon as it closes, they sell, and they get filled on the open of the next bar. But look what takes place over here. We're getting a lot of bars with tails on the bottom, and we're also starting to get some bull bars. The bears are less confident of the market continuing down. Instead of holding for a swing down, a lot of the bears are scalping. It goes down a little bit and they buy. And the bulls see what's going on as well. The bulls now are beginning to buy. They're beginning to buy below bars. They're beginning to buy bear closes, betting that they should be able to make a scalp that will probably get a minor reversal or possibly even a major reversal. Let's say you're a sell to close bear, been making money here, and let's say you choose to sell that close. And then you get this bull bar, and you get a bull doji after it. What are you thinking? Are you happy, or are you disappointed? Well, you're probably disappointed, and you might be afraid that you might have sold the low close of the day. And in fact, it was the low close of the day. Once you see this disappointment, you might be thinking, well, maybe it's a minor reversal. Maybe we're pulling back into a trading range or a bear flag. Possibly we're reversing. However, it's reasonable to sell that close if you're an experienced trader, because you know the first reversal up probably will be minor. You can sell that close, sell more higher, place a limit order to get out break even and avoid a loss. You can use a wide stop, sell the close, scale in higher, rely on your stop, and then get out at the midpoint of your two entries. You sell here, maybe sell more here. Here's your average entry price here. You can get out and avoid a loss. If you're lucky, it'll come all the way down below your original entry, and you'll be able to get out break even on your first short, and then with a profit on your second short. If it does not get down to that low close and reverses up, you can get out on the reversal up. You get a small profit here, a small loss here, and you end up with a small loss on the trade, which is okay. A lot of the bears who did scale in, selling this close, selling more higher, trying to get out at that low close, if they see this reversal up, they'll get out and just take the loss. They're concerned that the market was not able to get down to that low close. And what does that tell them? It tells them that the bears were desperate to get out. They were so eager to buy back their shorts, they started placing limit orders above the low close. And the bulls knew the bears were in trouble, and the bulls started to place limit orders above that low close as well. Had you sold this bear close, would you be disappointed by this bull bar? Of course you would be, and you'd be even more disappointed by this bar. So you'd be eager to get out without a loss or with a minimum loss. Would you continue to swing trade, hoping for the bear trend to continue? Or instead, would you try to get out break even or maybe scale in higher and look for a little scalp? Or would you just totally give up and try to get out around your original entry price? The bears who did that were able to do that here. They were not able to do that here. All of these little tails up around this low close and then here at a slightly higher price is telling you that the bear trend traders are giving up. And if the bear trend traders are giving up, we'll probably get at least 2 legs up and possibly even a swing up, which we did. And the bulls sense what's going on and they're trying to buy exactly where the bears are trying to buy. For example, for the bears, it's a double top bear flag. The bulls see that the bears are trying to get out break even. The bulls will buy at the low of that bar, betting that there'll be bears with limit orders trying to buy just a little bit lower. And they correctly picked a bad bear flag and the low of the day. Strongly sell the close here. We're trying to resume down with that big tail, and after these bull bars, this is a lower probability sell the close bar. But the trend could continue down for the rest of the day. Experienced traders will sell that, but you only do that if you're comfortable holding through the minor reversal and scale in higher, and then managing to get out without a loss. We're starting to get two-sided trading, tails, bull bars. Okay to sell, but it requires more management, and your shorts selling that close are probably going to be scalps, or they'll require scaling in, and then you can avoid a loss. For example, if you sell that close, you might sell more 1 point higher, 2 points higher with limit orders, and then place a limit order to get out break even on your trade when it gets back to your average entry price. And therefore, your goal has changed. Instead of hoping to make a profit, now you're simply trying to avoid a loss. If you sold this close, sold more 1 point higher, sold more 2 points higher, this is your average entry price. A lot of the bears will try to get out break even at their average entry price. I want to talk some about a buy the close bull trend. Strong reversal, the bears are giving up. The bulls sense that and they're buying for any reason. They especially like to buy bull closes. This is a buy the close bull trend. They'll keep buying until it's no longer profitable, and some will buy this close, they'll buy that close, and they'll even buy that close. But they'll only buy closes late in the trend, especially after bear bars, if they know how to manage their trades. Strong enough rally, probably at least a small second leg up, and they got a second leg up. That's the minimum objective. However, they did not like to see this bear bar right after this bull bar, especially with this bull bar being a little bit bigger than these. This could be a climactic end to the trend, and therefore there's a magnet at the low of the buy climax, and the market might test back down there. A lot of the bulls who bought that close did not like this bear bar, and they decided that maybe I should just try to get out break even, and they placed a limit order to get out at that high close. And you can see what happened with this bear bar right here. It went one tick above that high close and turned down. Why did it do that? Because the buy the close bulls here were disappointed by that bear bar here, and they placed limit orders to get out break even. When it went back above their entry price, they sold. The bulls sold. The bears knew the bulls would do that, and they sold as well. Buy climax, but instead of consecutive bull bars, we're getting pullbacks. The breakout phase now has ended, and this is now a channel phase. Most bulls would not treat this as buy the close. It's still a bull trend, but they're going to be cautious buying high closes because we're starting to get pullbacks. Bull bar, pullback, bull bar, pullback, bull bar, bad follow through. And they are therefore concerned that we have a spike and now a channel and soon a trading range, and they don't want to be buying high. Traders who buy closes watch the behavior around the high close in a bull trend and around the low close in a bear trend. If the market is starting to stall at the high close, it might soon be converting into a trading range or possibly reversing down. This is not noise, this is information. This is not noise, it's information. It's telling you what traders are doing. In this video, I talked about the importance of the high and low closes in trends and how they're important support and resistance. I then talked about sell the close bear trends, and once the bears are disappointed, how do they behave when the market gets back down to that low close? And the opposite is true in a buy the close bull trend. If the bulls are starting to get disappointed by the bars after strong bull bars, are they trying to get out break even, or are they holding, and is the trend continuing? I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 5 videos on entering late in trends. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on entering late in trends. I'll begin by talking about the final trend bar. Every trend up or down, when you look back at it after a reversal, you can find the final trend bar. And that's important because institutions trade using line charts and not bar charts. And then the high close in a bull trend and the low close in a bear trend become important. At some point when a trend reverses, there is a bar or a series of bars that indicate that the trend traders are giving up and that the traders in the opposite direction are taking control. I refer to these as give up bars. And finally, I'm going to be talking a little bit about strong bear breakouts. We have a bull trend, and at some point after it reverses, you look back and say, that was the final strong bull trend bar. There was one more small bull bar with a slightly higher close, but this was the final time when bulls were actually clearly in control. Again, after this reverses, this is the final bull trend bar of that leg up. Again, a brief final bull trend bar. The bulls own the market for only one bar. This was potentially the final bull trend bar, but the bulls got another leg up, and then this became the final bull bar. Here, possibly the final bull trend bar, strong enough rally probably will go at least a little bit higher. Again, a potential final bull trend bar, we went a little bit higher, and we may go higher still. If you're trading this, you might be buying for a variety of reasons, and one might be you'll buy the close. Every time you see a bull bar, you buy the close, betting that the market will go at least a little bit higher, knowing that eventually it will not. Eventually there'll be a final bull trend bar that will be the high close of the rally, and the market will then go the other way. What do you do if you buy that high close and then you see this bear bar immediately afterwards, especially since you might be at the top of a trading range? Bear bars, any one of them could be the final bear trend bar. In hindsight, after you get a strong reversal, you know that this was the final bear trend bar, and the same with that. And after this reversal, we had many possible candidates for the final bear trend bar, but this turned out to be the final bear trend bar of this bear trend. It's in a bear trend, so traders are selling for any reason. And one common way to trade is if there's a strong bear trend bar, you sell the close, believing that the odds are a strong bear trend bar likely means we're going to get lower prices. Everyone knows that one of the bars will not have lower prices, and in fact, it'll be the final bear trend bar, and then we'll get a reversal. Had you sold this bear bar, what are you thinking after you see this bull bar? You're thinking that maybe I sold the final bear trend bar and the market is about to reverse. A bull trend bar, not especially big, so not especially strong, but buy the closed bulls will still buy, hoping that the trend continues higher, knowing that it might not. When the channel up is this tight, the first reversal down probably will be minor, and the best the bears will get is a pullback into a bull flag. If the bulls buy here, they know they probably will be able to get out break even because the first reversal is minor, and the bull trend will probably resume enough for these bulls to get out break even or with a small profit or a small loss. What's happening here? We got a bear bar after that final bull bar, and the bulls are no longer aggressively buying. So had you bought that final bull closed right here, and then you see this bear bar, you probably are disappointed, and you probably have to be rethinking your plan. You're looking to the left, maybe we're at the top of a developing trading range, maybe we have a double top neckline, maybe we'll break to a measured move down. However, when the channel up is this tight, usually the first reversal down is minor. The bears see what's going on as well. When they see the close of that bear bar, they're thinking, oh, maybe we're winning. Every time a bull buys, there has to be a bear that sells. And at this point, the bears are pretty hopeful that they may have stopped the bull trend. What took place here? Well, I call this a give-up bar. The bulls are giving up. And if they did not give up earlier after buying that close, a lot of them are giving up with this second pair of consecutive bear bars. Bulls and bears sell. The bulls are giving up, and the bears are selling, expecting at least a couple legs down. Big bear bar, the biggest bear bar, 20 or more bars into a trend, more likely an exhaustion bar, meaning that the bears are probably exhausted and that will probably have to go sideways to up for 5 or 10 or more bars before the bears can regain control again. What took place here? A lot of the bears are quickly buying back their shorts. They saw this very big bear bar as a gift, a sudden, unexpected big profit, and they're taking their profit. And the bulls see the same thing, and they're buying as well. After a sell climax, the bears buy back their shorts, the bulls start to buy. Usually you're going to get at least a couple small legs up. And what took place here? Some of the bears held short, even with this bull bar, but at some point they give up, and this pair of bars probably represents the bears giving up. I talked about the bulls buying closes and the bulls buying this close and then being disappointed by this bear bar and the next several bear bars. The bulls knew they were at the top of the trading range, but they thought the momentum up was strong enough so they had a reasonable chance of breaking above. They also knew that the momentum up is strong enough so that the first reversal down would allow them to get out break even. It would be a bull flag, and the market would test back up to their original entry price. What happened to these bulls after they saw this disappointing follow through? A lot of them placed limit orders to get out break even. They bought that close, disappointed by this bar, tried to get out break even. Maybe they were successful on these bars, and then they had another chance to get out break even here. And what happened when the market went back above their entry price? We have a tail on the top of the bar. It went above the entry price of these buy the close bulls and immediately reversed down. Why would that happen? Well, part of the reason is a lot of these bulls were so disappointed by this and knowing the context, a possible trading range top, they decided to get out break even. They placed a limit order to get out at their entry price. And as soon as the market went a little bit above their entry price, they got out. And the bears knew the bulls were disappointed as well. And therefore, they're looking to sell at the same price, knowing that the bulls will get out there. Bulls and bears selling resulted in that. Some bulls decided that, well, this channel is so tight, chances are, even if we get a big sell-off, the best the bears get is a trading range. The market probably will not fall below this low before it gets back up to that entry price. These buy the close bulls are scale-in bulls, and they'll buy more above a bull bar. When they see this sell-off, especially around a 50% pullback of this rally and a test of that low, they place a limit order to buy on a stop above the bull bar. So they bought here, they bought more here. Their average entry price is the midpoint. They could get out at their average entry price right here. Small loss here, small profit here, break even on the trade. Others will try to get out on the test of that high close, trying to get out break even on their first entry, and then with a profit on their second entry. And you can see we got exactly to that high close and stalled. Most of the bulls who tried to get out at that close were unable. And then they see this small bear bar after that test of that close where they're trying to exit. And they're deciding that, oh, maybe it's not going to allow me out. So some of them started to sell at the market or below bars or even above bars. They'll take a small loss on this entry. Their profit on this entry will be bigger, and they'll end up with a small profit on the trade. What does this tail on the top of this bar and this bar tell you? It tells you that traders were selling, and a lot of those sellers were bulls who bought this close, hoping to be able to get out without a loss. Some did not scale in. They just simply relied on their stop and bet that we would either continue up and they'd make a profit, or if we sold off, it'll be a bear leg in a trading range and we'd test back up to the top of the range. In any case, you had bulls who bought that close trying to sell, and when it got at that close, it pulled back. Got at the close, pulled back. I mentioned give up bars. I want to talk a little bit about them now. The bulls who bought this close, whether or not they scaled in, tried to get out break even at that close. It had to get one tick above that close for them to get out. Very few were able to get out with their limit order exactly at that close. And now we have that tail, and now we have a bear bar. So this might be a possible failed breakout. A lot of the bulls will get out on the reversal down below the bear bar. Small loss on the first entry, a bigger profit on the second entry, and they end up with a small profit on the trade. What took place here? Some of the bulls who bought that close did not get their fill here, and they did not exit on the reversal down. And they held, hoping that we would still go higher. But now we're getting a second entry short here and then here. And a lot of them gave up on the breakout below this small tight trading range. That created this big bear bar. This is the final bulls giving up. The bulls who bought that close, unable to get out break even. They had several chances to get back up to their entry price and get out without a loss, and they were unable. And this is where they gave up. And this is a give up bar. The bulls are giving up, and bears are selling as well. They know the bulls are trapped, and therefore the bulls are going to have to sell out of their longs, and the bears sold, betting that the bulls would be selling as well. Strong bear sell-off, 2, 3, 4 consecutive bear bars. Bears were selling for any reason, including selling closes. Some sold maybe at one of the closes and then added on. Some bear sold this close, hoping that the bear trend would continue down, knowing that if it reversed up and he managed his trade correctly, he could avoid a loss. Biggest bear bar, or one of the biggest bear bars in the bear trend, so possibly an exhaustion bar, and it's testing near the bottom of the bull swing as well, and therefore it's at support and we could reverse up. You have a big bar, a sell climax, possible exhaustion, now at support. This could be a sell vacuum test of support, and that could lead to an abrupt reversal. However, when the channel down is this tight, the first reversal up is minor. A lot of the bears who sold that close will use a wide stop, maybe up here or here, and look to sell more higher, maybe 2 points higher, just below the top of the final sell climax bar, betting that the channel is so tight, the reversal is minor, the bears should be able to get at least a resumption attempt back down. Finally, I want to talk a little bit about strong bear breakouts. Again, you have a strong sell-off. Bears sold here, and they were disappointed by this. A lot tried to get out break even at that close, and this got close to it. They were unable. Others sold more higher. If they were very disappointed by this rally, they would try to get out break even on their trade. One entry price is here, one entry price is here, their average is here. This bar allowed them to get out break even on the trade. It did not get below this close, and therefore they ended up with a loss on this sell. When this reversed up strongly like this, the bears who did not get out break even on the entire trade gave up. This is a big give up bar for the bears. The bears who sold this close were confident that they could avoid a loss by scaling in higher and getting out at the midpoint between their two entry prices. They were hoping to make a profit, get out break even on their first entry, and then with a profit on their second. What this tells us is most of the bears who sold this close and sold more higher decided that they just wanted to get out break even. You can see we did not get below that close. In fact, we only got to within 2 ticks of that close. And that tells me that there were a lot of buyers somewhere in the midpoint between these two locations where bears would sell. In other words, the bears were so eager to get out, avoiding a loss, that they gave up on the idea of getting a profit. And the bears were buying so aggressively, we got this. And this is the final bears giving up. The bears who tried to get out at this close, they see it got to within a couple ticks of their limit order and started to reverse up quickly, and they just bought at the market, trying to reduce their loss. This tells us that the bears were not trying to get out with a profit. They were simply trying to avoid a loss by scaling in. The bears who were trying to get out back at that low close, once they saw the market start to reverse up 2 ticks above their limit order to get out at that low close. The bulls understood what was going on, and they knew the bears were trapped, and when it started to reverse up, the bulls started to buy aggressively. We have a trading range and a bear leg in the trading range. Here we have 3 consecutive bear bars. We're getting a strong breakout and follow through below the bottom of the range. We have a spike pullback channel. We're also getting a breakout below the bottom of the channel. It's a sell the close sell off. The odds are we're going to go lower. There's not a guarantee that we'll go lower, but given this context and 3 consecutive bear bars, 60% chance we're going lower. That means 40% chance we will not go lower. Once you get a decent bear bar and a second consecutive bear bar, the market's always in short, and that means the probability is we'll go at least lower enough for the bears to make a profit. Bears will start to sell closes. They'll sell that close, they'll sell this close, and this is a breakout to a new low in the trading range. Most of the bears would put their stop above the top of this final sell climax. The first target that I always consider when I see a breakout like this is a measured move down based upon the bodies, the open of the first bar to the close of the final bar, expecting a measured move down. That's also at a support level, so there's another magnet, another reason to get down there. At the moment this bar closed, there was a 60% chance the market would get here before it got here. The reward is equal to the risk. 60% chance we get to the reward before the risk, and therefore the trader's equation is positive. We had an attempt at a higher low here, and we broke strongly below it. Another measured move projection is based upon the height of this bear leg. The bulls hoped it was going to lead to a second leg up. Instead, we got a bear breakout below what they thought was a bull flag. Again, bears will sell closes, looking for a test of support here, this measured move, or the bottom of the bull trend. I began by talking about final trend bars. Every trend, after you see it reverse, had a final trend bar, and it's important. Traders are buying closes in bull trends, selling closes in bear trends, and if they get trapped, they have to give up. If the market's in a bull trend and the bulls decide that it's disappointing, the follow through is disappointing, they try to get out, and if enough of them give up all at the same time, you get a bear trend bar, which is a give up bar. And the opposite is true at the bottom of a bear trend. If the bears are selling and then they see something that disappoints them, a lot of them will suddenly give up and you'll get a bull trend bar. And I finished up by talking about strong bear breakouts, and I'll continue the discussion that I began at the end of this video. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the third of 5 videos on entering late in trends. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on entering late in trends. I'm going to continue a little bit what I talked about in the final slides of the last video about disappointed bears, bears who sell closes and then they get a bar that disappoints them, like a bull reversal bar right after they enter. And then I talk about how they get trapped by those disappointment bars at the end of a bear trend and how they then give up. They exit, and that creates a give up bar, a bull trend bar, which represents the final bears giving up. We have a spike and pullback and channel bull trend, so spike, wedge. And we have a sell-off, a weak sell-off. It looks like a bear leg in a trading range, and therefore will probably go higher. Instead, we got this. We have a bear breakout. Once you have 2 consecutive big bear bars like this, breaking below what should have been support, the market's always in short. The odds are we're going lower, probably for some measured move down. Now we have a 3rd consecutive decent bear bar closing below its midpoint. 60% chance the market will fall for a measured move down, maybe based upon the open of the first bar to the close of the final bar. So 60% chance it'll get down here before it gets back up here where the bears have their stops. This is a sell to close market by the second close. By the second close, the market's always in short. 60% chance will fall for a measured move. 40% chance we will not. The bears who sell for any reason, for example, if they sell this close, 40% chance it's going to get here before it falls for a measured move down. Look at this. We have a bar with a big tail on the bottom, but it does not have a bull close. Some bears will sell that close as well, betting that the reversal will be minor, a bear flag, and that the bear trend will continue down. They don't sell every close, but bears looking to sell look to sell closes as a very good way to sell in a bear trend. Some bears sell every close and they just keep adding to their position. Most traders sell once, maybe add on one more time. Traders who did not sell here or here might finally decide to sell the close here, confident there's a 60% chance we're going lower before it gets up to their stop level. A lot of bears, when they see a big tail like this, they stop selling. They know we'll get a minor reversal and they'll be able to sell higher. However, some bears will aggressively sell the close all the way down, including the close of this reversal bar, knowing that it does not have a bull body, and the odds are, if it does start to reverse, the reversal will be minor and the bear trend will continue. You can only do that if you can manage your trades correctly and if you can scale in and use the appropriate stops. It sounds easy, but it's not. And this is for advanced traders only. What do you do if you sold that close and now we have a second reversal bar? Yes, there's not a bull body, but it still has a very big tail on the bottom. That tells you that the market went down and people bought, and went down again and traders bought again. Bulls bought betting on a higher low compared to the bottom of the bull trend, and a lot of bears bought because they were disappointed by the follow through and they're trying to get out break even or with a small profit depending on where they sold. A lot of the bears who sold this close know there's a big tail on the bottom and that the market might soon begin to transition into a trading range. And therefore, a lot of them are looking to scalp, maybe for 2 points. So they might sell this close and place a limit order to buy back 2 points lower, and they're willing to scale in higher if it does not get down to their target. This is 2 points below that close. If a bear sold that close, he puts a limit order 2 points down, which is right at the low of this bar. And look at the low of this bar. It did not get down to the low of that bar, and therefore it missed filling the limit order by 1 tick. It fell 8 ticks from that close. Most of the bears have their limit orders 8 ticks down, and those orders are not filled. 95% of the time, it has to go 9 ticks for you to exit with 8 ticks on a limit order. The market reversed up pretty quickly without filling those orders. If you're a bear scalper who sold this close and looked for a 2 points profit, and it hit your limit order, did not fill you, and now is back to your entry price, what are you going to do? If you're a scalper, you'll probably buy back your short, either on the way up or right around your entry price. Why did the market do this? Because too many bears do not believe in the bear trend. The market sold off, went up. Bears started scalping and went down again and went up. Bears are scalping. Instead of holding for a swing trade, they're taking quick profits. And the bulls are buying as well. Now what do you do if you did not exit your short? Think about this for a second. We have a micro double bottom. Disappointed bears who were hoping to make a 2 point scalp probably are giving up. Some of the bears who sold this close and then they see this second doji bar, instead of trying for a 2 points profit, they'll raise their limit order to 1 point below their entry price. They sold here. They were disappointed that they did not get filled here. They'll then raise their profit target to 1 point below their entry. And look at the low of this bar. It fell exactly 4 ticks from their entry, and therefore they did not get filled. Just like they did not get filled for 2 points profit here, they did not get filled for 1 point profit here. It had to fall 5 ticks from that close where they sold. It only fell 4 ticks. Again, it hit their limit order and reversed up. A lot of those bears then would finally give up and try to get out break even and give up trying to make a profit. What's going on now? Well, we're rallying for about 8 bars with small pullbacks, a 1 tick pullback here. The market looks like it's beginning to reverse this sell-off. Look at this. This low fell 1 tick below this close. Some of the bears held short through this, and instead of trying for a 2 point profit or for a 1 point profit, now after they see this bull bar, if they did not already get out, they're trying to get out break even. And it had to fall 1 tick below their entry price. They sold here, and this low went 1 tick below their entry price and reversed up. That tells you that a lot of the bears who did not get out earlier are finally getting out. It fell 1 tick below their entry price. The market allowed them to get out. The bears who did not take the opportunities to get out break even now are starting to look for reasons to get out. Now the bears who are still remaining will get out with a loss. For example, they might buy with a limit order below the low of this bull bar, betting that it's a low probability sell and there probably are buyers below. Some of those buyers are bears buying back their shorts, trying to minimize their loss. Not all of those bears exited, and there are always some trapped bears at the end of a bear trend, and I want to talk about them right now. The bulls knew that the bars were big enough so that the bears who sold that close were hoping for a 2 point profit. And then once they were unable to get their 2 point profit, they'd try for a 1 point profit. And once they were unable to get their 1 point profit, they would try to get out break even. If you're a bull and you know that, you know the bears are going to try to buy 8 ticks below this bar, and then if not filled, they'll try to buy 4 ticks below that close. Those bulls are placing limit orders a tick or two above where the bears are trying to exit with a profit, trying to keep the bears from making their profit and forcing the bears to buy back their shorts at a higher price, which could lead to a reversal. Some of these bulls who bought either here or here will put their stop right below the micro double bottom. Small risk. Usually when your risk is small, the probability of success is small as well. At this point, the market's still always in short, and it's still always in short here. So the probability is that we're going lower. However, the risk is small enough and the reward is big enough so that it's still mathematically okay for the bulls to take these buys. They lose most of the time, but the reward is 2 or 3 times greater than their risk, and it makes the trader's equation positive. For example, the bulls who bought here, they knew the bears needed the market to fall 5 ticks to make a 1 point profit had they sold this close. Therefore, the bulls placed a limit order to buy 2, 3, or 4 ticks below that close, hoping that enough other bulls would buy as well, trapping the bears. The bears would then not get their 1 point profit, and they would have to buy back higher. The bulls who did buy here probably would put their stop below the micro double bottom. These bulls are betting on a tight trading range rather than a continued bear trend. They know the reversal is probably minor, and the best they'll probably get is a trading range. However, they know also sometimes a minor reversal leads into a major reversal into a bull trend. Usually, if you're buying in a bear trend, you're scalping, expecting a trading range. You're expecting the bear trend to end and evolve into a trading range. This is what the bulls see. They see that the market fell for about a measured move based upon the height of this potential bull flag. It's a higher low. It's turning up above the bottom of the bull breakout. And we have a micro double bottom, all good for the bulls. Final bears, most of the final bears will be exiting here with a small loss. They know that we're probably going to begin to enter a trading range. Less likely a major reversal, but probably at least a trading range. And a lot of the bears will get out and give the bulls an opportunity to reverse the market. If after 5 or 10 bars, the bulls are unable to reverse the market, the bears will sell again for trend resumption down. Some bulls will buy betting that we have a higher low at a measured move target and a micro double bottom. They'll buy on a stop betting on a swing up, at least to the top of the sell climax. In general, when you have a sell climax like this, you have a 40% chance that the market will get to the top of the sell climax before falling for a measured move down. The bears take the higher probability bet that we're going down for the measured move. The bulls take the lower probability bet, betting that we'll go up to the top of the sell climax. Bears are starting to give up, and the result is every little small pullback, the bears are buying back their shorts. And these are any of the bears who sold anywhere in here or anywhere up here. They're sensing that the market is having an increased probability of a reversal, and therefore any small reversal down, the bears are selling, trying to minimize their losses, or if they bought higher, trying to maximize their profits. When the market's in a strong bear breakout, bears are selling for any reason. A popular way to trade it is to sell closes. However, at some point, you end up selling the final bear close in the bear trend and the market reverses, and those bears will give up. The bears who did not get out for any of those reasons that I talked about earlier have to have a stop. One logical location for a stop is the top of the sell climax or the top of the bear leg. Some bears will scale in around that stop level, betting that the market will fall enough so they can get out break even. Let's say a bear sold this close. He might sell more below a bear bar here, or he might sell more 2, 3, 4 points higher, hoping that the market will pull back far enough so that he can exit break even between his two entry prices. If he sold here, or if he sold here or here, his average price would be here. He's hoping for a pullback down far enough to exit break even on the trade, avoid a loss. As long as the market keeps making lower highs, it's still in a bear trend. However, if it breaks above a major lower high, like here or here, then the premise of a bear channel is no longer valid. The market then is either in a trading range or a bull trend. If bears sold on the premise that it's a bear trend, and now there's evidence it is not, they'll buy back their shorts. They'll give up. The bears who held on here, or other bears who sold here, or if they added to their position up here, are hoping for a double top with the top of the sell climax or with this lower high. Their stop is not far above. And what does that tell you? If they sell here and their stop is just a little bit above at those black lines, either of those black lines, their risk is very small. Anytime you take a trade where the risk is very small, you're probably going to lose. If you have a fantastic risk-reward ratio, which is what you get with a very small risk, chances are you're going to lose. If you have a great risk-reward ratio, then you have to have terrible probability, low probability, because otherwise you'd have a perfect trade, and perfect trades cannot exist. There always has to be somebody willing to take the other side of your trade. And if your trade has a very high probability of a big profit with very little risk, it's perfect, and nobody's going to take the opposite. Therefore, if you're selling here with very little risk, putting a stop just above either of those lines or at either of those lines, you're probably going to lose. But the math is still acceptable to take the short. Not only is the risk small, and that alone makes the probability small, the bull channel is very tight. We're probably always in long, which means the probability is we're going higher. And that tight channel further reduces the probability of bears selling just below their stops. What took place here? The market went above the two logical stop areas, the top of the sell climax, the top of the bear leg, and the bears gave up. You also had bulls buying as well, knowing that now the bears no longer think of this as a bear trend. They think of it either as a trading range or a bull trend. Bulls buy on a stop at their stop level or their higher stop level here. They buy the breakout. Some will simply buy at the market. Some will buy the close of that bar. Strong enough breakout, a breakout and a follow-through bar, probably at least a small second leg up, and therefore the first reversal down is minor, and bulls will buy at the low of that bar, betting that there'll be buyers below and that will continue higher. They buy at the low of that bar and put a stop either below the bottom of the bull breakout or the bottom of the bull leg. Bears are hoping for a trading range. Some bears who are not short here or who bought back their shorts for any reason are betting that the market's in a trading range. We went up, we went down, we've been sideways for 50 or 60 bars. If it's a trading range, traders will buy below bars. They'll buy below this bar and buy more lower, betting that it'll get back above that low. They can get out break even on their first entry and with a profit on their second entry. Bears will do the opposite. They'll sell above bars, betting that whatever breakout we get, they can sell more higher, and the market will probably come back below their breakout point. And therefore, you will have bears selling at the location where a lot of bears are exiting with stops. Big bull breakout and follow through. If you were a bear and you sold with a stop above this high or above that high, you're probably disappointed by this follow through. And a lot of the bears who took that sell either will sell more higher and try to get out break even in between their two entry prices, or they'll simply give up, buy back their shorts for a loss. And the result is a pair of bull breakout bars. This is the bears giving up, and it's also aggressive bulls buying. Bears buy back their shorts on the first reversal down at the low of that bar, betting that it's probably not going to be a failed bull breakout and the start of a bear trend. It's probably going to be a minor reversal, and this is strong enough so that we'll get at least a small second leg up. Other bears would exit on a stop. We have a bull breakout and a pullback. This is a high 1 buy signal bar. They might buy above the high of that bar. Now we have a high 2, a small double bottom, high 1, pullback, high 2, and they might buy above the high of that bear bar or the high of this bull bar to take a loss, exit with a loss. You know the bulls are always buying. Now we know the bears are buying as well. If both the bulls and bears are buying, the odds are we'll go at least a little bit higher, possibly for a measured move up. We twice tried to reverse down and could not get below the breakout point and could not get below this high. Therefore, this might be a measuring gap for a measured move up. I began by talking about disappointed bears. For example, if the market's in a strong bear trend and bears are selling closes, and then they get a bar that they think is disappointing and could lead to a reversal, they have to make decisions on how to trade. Bears can get trapped at the end of a bear trend, and they have to make decisions on how to either reduce their losses or try to get a small profit. Eventually, traders who are selling closes in a strong bear trend give up. They have to buy back their shorts because eventually every trend ends and it reverses. And traders need to know how to read when a trend is ending, and they also have to know how to give up and how to reduce their losses. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on entering late in trends. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on entering late in trends. There are several things that I want to talk about today. First, if there's a very strong breakout late in a bull trend, a lot of traders will fade it, bet against it, because it's more likely a climactic end of the trend than the start of an even stronger leg up. Always in short means that you believe prices are going lower, and therefore you should look to sell. A lot of times traders don't pay much attention to a tight trading range. Sometimes people will refer to it as noise, but the market is always giving information if you pay attention to what it's trying to tell you. And sometimes you can get a very major reversal out of a tight trading range. For example, you can get a double top within the tight trading range. If it's a lower high, it can lead to a lower high major trend reversal. And the opposite is true at the bottom. You can get a double bottom within a tight trading range, and it could lead to a very big bull trend. Just like a strong breakout at the top of a bull trend often is a climactic end of the trend, if you're late in a bear trend and you suddenly get a very strong big bear breakout, it's probably going to be the climactic end of the trend rather than the beginning of an even stronger bear leg. Anytime you have a buy climax, it always ends at resistance. Anytime you have a sell climax, it always ends at support. The market's in a bull trend, and then it entered a pretty tight trading range here. Once the market goes sideways in a very tight range like this for about 10 bars, I refer to it as a tight trading range. Initially, it's a pullback, and the odds are it's going higher, but every bar that gets added to it makes the market closer and closer to 50-50. 50% chance the bulls will get trend resumption up, 50% chance the bears will get trend reversal down. The market is rallying, forming higher highs, and it tried to get a wedge top here, and then a micro double top, and it reversed down, yet it immediately reversed back up. A micro double bottom, 2 bull bars closing on their highs. This is probably a failed wedge top, a higher low in a bull channel, and the market probably will continue higher. In general, if you have a reasonable top and the market instead goes higher, you're going to get at least 2 legs up, 1 pullback 2. That's the minimum goal. And this is the best looking bull bar in the past 10 bars or so. That makes you wonder, is it going to be a climactic end of a trend? Climaxes do not mean reversal into an opposite trend. Most of the time, the climax simply means the bulls are exhausted. They'll take profits and then they'll wait 5 or 10 bars to see what happens. They'll try to get trend resumption up, but sometimes they'll get overwhelmed and will get trend reversal down. Unusual strength late in a bull trend, more likely a climactic end of the trend, and the market will go sideways. And 40% of the time, you'll get a climactic reversal. The bears tried to get a wedge here. Now they're trying to get another wedge here. You get a buy climax and a wedge top. Also, it's a measured move up from the top of this trading range. We have a very strong bull leg. We tried to reverse down twice above it, and we continued up. Aggressive bears, they'll sell that bull close, betting that Maybe we'll get a small second leg up, but we'll probably get a test back down to the bottom of this buy climax before very long. And you can see that's what took place over here. Other bears will wait for the bar after the buy climax bar and then either sell its close or sell below its low. Or if there's a bear bar within a bar or two, the bears might sell with a stop below the low of that bear bar, looking for, at a minimum, a test of the bottom of the buy climax bar and possibly a test down to the bottom of the wedge. 3 pushes up, 1, 2, 3. You'll have some bears who simply will place a limit order to sell at the top of the channel, betting that we'll get at least a pullback. If you take that short, where's your stop? Well, one reasonable place is a little bit more than a measured move up. The bottom to the top of the buy climax, there's your measured move, that yellow line, and you put your stop just a little bit above, just in case we get one more small leg up after this bull breakout. Very often when you get a buy climax, you get a pullback and you get one more leg up before you get the reversal. Minimum target always is the bottom of the buy climax. Whenever you have any kind of a buy climax, the first target for the reversal is the bottom of that climax. If it's a 2 or a 3 bar buy climax, the target is still the bottom of the climax. If you're a bear and you shorted for any reason up here, and you're looking for a test down to this low, and you're risking about as much as you're hoping to gain, in other words, your risk is equal to your reward, you can only take that short if you believe there's at least a 60% chance that you'll make your profit before your stop is hit. Otherwise, you cannot take the trade. Any trade where the reward is equal to the risk is not worth taking unless you believe the probability is at least 60%. In this particular circumstance, I think it's a reasonable bet. And you might end up getting a swing down, although I think it's too early to take a swing short here. The channel up is so tight, the first reversal down is minor, and the best the bears probably will get is a trading range. Once it's in a trading range, then you can look for a major reversal. If you look at the chart and you believe the prices are going lower, then you probably believe the market's always in short. Whenever I use the term always in short, if I had to be in the market at this instant, I would choose to be short, because by saying always in short, I believe prices are going lower. At this point, we have a bull channel. A wedge rally is a bull channel, and we have a break below the trend line. Not much selling pressure. The bears are hoping this is a lower high major trend reversal. Since the pattern is small, only maybe 5 bars down, 5 bars up, or you can say 10 bars down and only 3 bars up, it's probably a minor reversal and the market will have to go sideways more. However, if you then get a double top in the tight trading range 5 or 10 bars later, the probability is 40% that you're going to get 2 legs down, 1 pullback 2. And the math is very good for the bears, especially when they have a decent sell signal bar. Traders will sell below the low of that bar, put a stop just above, and they have a 40% chance of a reward that is at least twice as big as their risk. This, I think, is a minor reversal. There simply are not enough bars in the pattern, not enough bars down, not enough bars up to expect a major reversal at this point. However, at this point, now we've had 20 bars breaking below the full channel, and that is enough bars for a major trend reversal. And whenever I see a tight trading range that has a double top, and the tight trading range is 10 or 20 bars long, and the space between the two tops is 5 or more bars, and I have a good sell signal bar, to me that is a reasonable sell setup, a 40% chance of 2 legs down, and a reward much greater than the risk. Strong bear breakout, close below the low of the past 20 bars or so. The odds are high that we'll get a second leg down. 1 pullback, 2. You can argue that it's a failed bear breakout, and you could therefore get out of shorts above this bull bar. But if you do, and you correctly believe that the market's probably still always in short, you have to be thinking about selling again below a bear bar. Here's a bear bar, so you would sell again there had you exited your shorts above that bull bar. At the close of this bar, a big bear bar closing below the low of the past 20 bars, and the market was in breakout mode for either a trend reversal down or trend resumption up, the odds at this point on the close of that bar is that we're going lower. It's okay to sell that close, put a stop above the top of this leg down, and then look for other reasons to sell as well. We have two legs up, one, pullback, two. You sell below that bear bar, especially since it did not get above the top of this initial leg down. And then you could start selling closes. You could sell that close or this close or any of those closes. You're not going to take all of those sell signals, but they're all reasonable with a stop above the top of the bear leg, right above the high of that bear reversal bar. Again, 40% chance you're going to get two legs down, and the legs down will be big enough for a swing trade. Testing the bottom of the wedge, that is a magnet. Also, we went sideways here, that is a magnet. And we broke above this trading range. We have a bull breakout here, so that high is also a magnet. So there's a lot of support in this area, and therefore bears will start to take profits and bulls will start to buy. You can see we're starting to get tails on the bottoms of the bars, and that means traders are buying into the close of the bar. Bulls are buying for scalps, and bears are buying back some of their shorts. I mentioned that a tight trading range can be a major trend reversal. We have a bull trend and then a tight trading range. The market is neutral. Whenever the market is in a trading range or a tight trading range after a bull trend, probability of trend resumption up versus trend resumption down is about 50-50. I always think it's slightly higher for the resumption traders, that it's slightly more likely the bull trend will resume. But every bar that gets added to the range makes the probability closer and closer to 50-50. We have a small double top in a tight trading range, and we have enough bars, more than 10 bars in the tight trading range, for traders to start to consider the possibility of a lower high major trend reversal. Again, I want at least 10 bars in the tight trading range. I want at least 5 bars between the two tops in the tight trading range, and I prefer the bear bar closing on its low or having no more than a one tick tail below. If I have that combination, it's a reasonable swing short looking for two legs down, putting a stop just above the high of that sell signal bar. The market would not be doing this if the bulls were very aggressive. They're clearly not willing to hold, and looks like they're buying below bars and scalping, and the bears are selling at the high of the prior bar and scalping. The bulls have changed what they're doing. Instead of buying closes, holding for higher prices, now instead of looking for swing buys, they're looking for scalps, and therefore the market is much less bullish than it was earlier. They'll also keep buying with stops above bars, hoping that this is a bull flag and that we're breaking out and getting trend resumption up. But at some point, they give up, and that's what took place right here. The bulls gave up. This is the bulls finally selling out of their lungs and then waiting for at least a second leg down before looking to buy again. The bears understand what the bulls are doing. They know the bulls are not aggressively buying, and they know a lot of the bulls who bought below bars will sell above to take profits, and the bears will sell above bars, betting that they'll either get a scalp down to the bottom of the range or possibly a reversal down. Remember, bull trend, tight trading range, about a 50% chance that the bears will get a reversal down, and therefore they'll start selling, either for scalps or for swings. The bulls have bought bull flags, for example, two legs down, 1, pullback too, and they buy with the stop above that bar, or they buy with the stop above this little bull bar, and then they see terrible follow through after their entry, they're going to be quick to get out because they're afraid that instead of bull trend resumption, will either go sideways or possibly even reverse down. The bulls are exiting quickly after bad stop entry buys. At some point, in this particular case, you had too many bears selling. You don't know that until this point. You do know there are not enough bulls buying because we're getting buy signals, but the market's not going up. So not enough bulls buying. The bulls and bears are balanced. And here the bulls gave up. They just decided that they are unable, after repeated attempts to resume the bull trend, they just give up and decide that it's too high to buy and they'll wait and buy lower. And this is where the bulls are exiting. And the bears know that the bulls are giving up, and therefore the bears are selling, expecting two legs down. I talked about a late breakout and a bull trend being a climax. If you have a bear trend and then you have a strong bear breakout, that too is probably a sell climax. Every bear bar, every series of bear bars is a breakout and a climax. So this is climactic selling, as is this, and this. Here we have a series of sell climaxes. This is also a sell climax, as is this, and so is that, even though this one's in a bull trend. Now look at this bear bar and compare it to all the other bear bars. What do you notice about it? Well, it's a big bear bar. In fact, if you look back, it's the biggest bear bar in the entire bear trend, and the bear trend has gone on for 30 bars. Whenever you have the biggest bear bar occurring 20 or more bars into a trend, it's more likely going to be the climactic end of the trend than the start of an even stronger leg down. That means that it's probably going to reverse up to the top of that final sell climax before it goes the same distance down. When the breakout is big like this, you often get a small second leg down before the reversal, but the odds still favor a reversal. And because of that, you'll have bulls who see that and they'll buy that close, betting that the bears will look at this and say, wow, that's a surprise. I wasn't expecting that much profit so quickly. And the bears will start to take profits and they'll decide they want to sell higher, take profits down here. And the bulls know that, and the bulls know after a series of consecutive sell climaxes, the market's probably going to reverse up for at least a couple legs. The bulls start buying. They'll buy that close. And after a second leg down, they'll look to buy a reversal up here or here. Is this a major trend reversal? Probably not. We only had 3 bars up, and you only have 4 or 5 bars down. The pattern is small, but sometimes you'll get a minor reversal that goes up high enough to make a swing profit. The bulls taking this buy, they might call it a higher low major trend reversal. It's more likely a conversion of a bear trend into a trading range. And if it's a trading range, the market will probably try to test a major lower high, like right here. So is that a major trend reversal? I don't know. I think of it more as a bull leg in a big trading range, even though it went up far enough for swing traders to make a profit. I think of it as a minor reversal, and that the rally will be a bull leg in a trading range, and it will probably be followed by a bear leg in the trading range. At a minimum, the bulls who buy expect the market to get above the top of the final bear leg. And if they buy here, this is the final bear leg. And they're hoping that if it gets above here, this is a neckline of a double bottom. You have a double bottom, a neckline, maybe a measured move up, maybe to the top of this bear leg. This is a major lower high. If a bull bought this close, he's expecting the market to get to the top of the most recent sell climax here before it gets the same distance down. He'll therefore buy that close and put a stop a little bit more than a measured move down, thinking that there's a 60% chance it'll get there before it gets below here. The math is good for taking that buy or this buy or that buy. 60% chance you're going to reach that before you reach this. Initial target is the top of that final sell climax. We had one more small sell climax. And you also expect at least 2 legs up. 1 pullback, 2. This is strong enough up so that we'll probably get at least a little bit more up. This sell climax is the biggest sell climax occurring more than 20 bars into a bear trend. Here it's probably about 40 bars into a bear trend, and it's probably a sell vacuum down to some support level. Less likely, it's an acceleration down to an even stronger bear trend. The bears can argue that it's testing the bottom of a trading range. We're going to break below and fall for a measured move down. 40% chance it'll do that. 60% chance it will not. A lot of bulls want higher probability, and they'll therefore look for other reasons why there might be support here. Every buy climax ends at resistance, and every sell climax ends at support. If you see a buy climax, look for other evidence of resistance. If you see a sell climax, look for evidence of support. That will make a reversal more likely. Every reversal takes place at support or resistance. In a bull trend, the reversal takes place at resistance, and in a bear trend, the reversal up takes place at support. Anytime you're getting any evidence of a potential reversal, like a sell climax, you should be looking to see if there are multiple reasons for the market to reverse up there. Look for reasons for support. Parabolic wedge, a very tight channel with 3 pushes. So 3 pushes make a wedge, tight channel make a parabolic wedge. That's good for the bulls. We're at the bottom of a trend line drawn across these lows. 3 pushes down, so it's a type of wedge, and you can see if I drew a trend line across the top of these highs, it'll be a wedge. It's also an expanding triangle. We went down, we went up. We went more down, we went more up, and now we're more down as well. Also, we have a bull breakout and a pullback. I can draw a line across the lows, and maybe this is a bear channel, bull flag. Now, you can say, well, Al, this is not part of this bear trend. Well, in fact, it is. You can see we got a reversal. The market often transitions when it's making a reversal. So it's in a bull trend here, and a lot of times the bear trend begins before the bull trend ends. So there's often a time like here where there's both a bull trend and a bear trend taking place. And very often a pullback in the bull trend before the bull trend ends, in fact, is the beginning of the bear trend. We have a double top here. This high is slightly below that high. I always look for a measured move down based upon the lower high first and see if the market starts to reverse. If it does, then I assume that's the end of the trend. If it goes a little bit below there, then I look at the measured move based upon the higher high of the double top. And you can see this is reversing up almost exactly from a measured move down from the lower high of this double top. That is a sign of support. We had a first leg down, and then a pullback to a wedge bear flag and a double top. And then we had a second leg down. And look at the length of that second leg. It's almost exactly the same as the first leg. So there's a leg 1, leg 2 measured move here as well. You can see there are many reasons why traders will be taking profit on their shorts and for bulls to be expecting a reversal, so the bulls are looking to buy. But you have to be paying attention. You have to look for things like this. I talked about how if you get a strong bull breakout late in a bull trend, it's more likely a climactic end of the trend. and not the start of an even stronger leg up. And then I talked about how if you believe the market is always in short, then you believe prices are going lower, and therefore it's better to look to sell. A tight trading range, it's easy to look at it and assume it's meaningless, but it's not. You can often get a double top lower high in a tight trading range, and it could lead to 2 legs down, a major trend reversal. And the opposite is true at the bottom of a bear trend. If the market enters a tight trading range and forms a small double bottom within that tight trading range, there's a 40% chance you'll get a major trend reversal up for a couple of legs. If you have a bear trend that lasts 20 or more bars, and then you suddenly get the best looking bear bar in the bear trend, it's more likely a climactic end of the trend than the beginning of an even stronger leg down. And every buy climax ends at resistance. Every sell climax ends at support. And the more support and resistance you see, the more likely you'll get a reversal. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on entering late in trends.